Everybody, and welcome to this RaboResearch Food and Agribusiness webinar coming to you from Sydney today and on the subject of sugar. But welcome, of course, to all our growers, all our clients and colleagues who are joining us up and down the coast, right up north, up in the tablelands there, down the North Queensland coast, and also colleagues and clients joining us in New South Wales as well. We hope you're all healthy and well, and as is the sign of the times, we're presenting from home today, so do bear in mind if we do have any sort of technical issues, but we're not expecting anything too much. Thank you for joining us, and look forward to a good session. Now, to start with, I should just introduce this webinar as an initiative of our Rabobank commodity sector groups. Within Rabobank, we have 8 different groups covering all different sectors, including sugar, cotton, grains, horticulture, all sorts of different things. And really, it's a coming together of our colleagues across the bank in branches, also in other functions, research, marketing, etc. And we meet regularly just to talk really about how we can deliver more value and more knowledge and experience to our clients. So this today is an initiative of that sector group, and has been sort of planned and organised through that method. Now, without further ado, let's get on to the webinar and the research content that we have for you today. And basically we are looking at, well, Brazil's mixing with Australian sugar, and I hope that becomes a bit more clear as we go forward. My name is Charlie Clack. I'm a commodity analyst with RaboResearch in Sydney. I cover sugar and cotton here locally. And today, for this big question, I'm also joined by Andy Duff, who is our Global Sector Strategist for Sugar and also the Head of F&A Research in South America. So welcome, Andy. Good to have you on with us today.
Thanks, Charlie. Good morning to everybody. Nice to be with you.
Excellent. And I know many of you will recognise Andy. Andy has been across to Australia on several occasions and has a huge amount of experience and knowledge in the sugar sector. So please do feel free to ask as many questions as you like. And there are a few methods you can do that. We're using Zoom today, so in the bar at the bottom, you'll be able to see a few options. You can either talk to us through the chat box, where everybody will be able to see what you're asking and saying. You can either raise your hand as well, and through raising your hand, we can put your camera and your audio on if you'd like to appear on the webinar as well. Or finally, there's the Q&A box. So you can just put in a question and we will, we have got 20 minutes or so at the end where we can sort of address all your questions and hopefully, come out with some more insights there. So thanks very much, and let's carry on. So today, me and Andy are talking kind of from both Brazil and Sydney, but we do have a whole heap of analysts all around the world, and not just covering sugar, but also sort of grains, animal protein, dairy, consumer foods as well. So that's our team of agribusiness analysts and where these insights come from today. But for today, for the session, we are looking at a few different topics, and we have started with the title, global trends that look for Australian sugar, and all that has changed quite drastically in the past 5 weeks or so. So to start with, we've got an update really on sugar, on OPEC, and on COVID-19. Then we'll shoot over to Andy to hear the influence that Brazil will be having this year and how that will play out in the coming year or so. And then back to Australia, what that kind of means for the Australian outlook and what it means for our growers and clients here as well. So, as mentioned, if we talked about 5 weeks ago, we would have been talking about the price surge that started the year. We'd have been in very good spirits because, of course, as we started the year, we touched those levels in Aussie dollar terms that were the highest since March 2017. Of course, many growers took that opportunity, of course, to price forward. But since we've seen that momentum has really failed to win through. And despite industry forecasts, you've seen quite a major slump back below those long-term averages, that 20-year average, and back to sort of the 360 mark. In terms of how that's come about, we can see that really a little bit more carefully on, I think, when we look at the global price. And here we see, I guess, a slightly different story. In terms of the Aussie price, we've seen it fall around about 14% since February. It goes quite a steep decline, but it's really been insulated quite a lot still by the fall in the Aussie dollar as well. So actually our fall has been sort of 14% or so, whereas elsewhere around the world, if you're exposed in US dollar terms, it has been a 23% fall, so quite sharply elsewhere. And we've got the Aussie dollar to thank for that insulation, not just in sugar, but also for a number of different commodities, which have high sort of export exposure. So where's the fall derived from? Well, there's one answer really for that fall, given that of course, the outlook was still fairly bullish back at the start of the year. And the outlook really, the reason for that fall really is playing into the oil price collapse. Initially, starting with the fall from January through into the first sort of few months of the year, where we saw the COVID-19 taking an impact in oil. That shut down in international travel, also in leisure, tourism, etc. Spent a lot of, firstly, demand concerns, but also speculator worries sent the oil price lower. And then the real sort of icing on the cake, and the primary driver that we see oil prices, we have seen oil prices so low, is coming after that was the OPEC fallout, which saw Russia and Saudi fall out about the limits on oil production, and of course they're sending that price lower given the apparent oversupply that is coming. Now, this was updated overnight, and since then we have seen the oil price bounce back, and almost just over 20%. So, still things are moving very, very quickly. But of course, this influence has been significant on the sugar market. And I think this is going to be something that Andy is going to touch on in a little bit more detail when we talk about Brazil and Brazil's influence and why oil here is making such a difference to the sugar price. But we mentioned COVID-19 here, and I just want to talk a little bit more about some of the other trends that we see in COVID-19, particularly around how it's impacting sugar. Now, it is a new unknown, and you see, infections creeping up at some somewhat scary rates at the moment, getting over 1 million cases globally. New challenges arising as well from that. Now, the first challenge, I think, is going to be impacting sugar. It's going to impact all industries. It's going to impact everybody, no matter where you are, really. It's a global recession, and that's what our expectations are for going forward from this pandemic. At the moment, we're using similar figures to the IMF, suggesting a global recession equal to, or at least as bad as the global financial crisis, which is a 0.6% global GDP contraction, and suggests that really quite a negative outlook in that sense. Of course, this is a calculation that's been done at the moment. We still haven't reached the peak of the COVID-19 outbreak, and of course it will really depend on the longevity and the seriousness of national lockdowns, to what extent this global recession will impact, of course, our day-to-day lives and also sugar as well. Something more sugar related is going to be the end user consumption. And there's been a lot of talk about how sugar will be impacted in terms of consumption by this. Really, we see initially actually food service and out-of-home consumption being hit relatively hard. Those sweets and soft drinks that you buy when you're out and about, out in town or going to the cinema, those sales are dropping dramatically, offset though to a large degree by store purchases, particularly for sweet processed food and other non-perishable items which have been so popular in sort of purchases at retail stores. Now, as a net result, it is a slight decline, I guess, in sort of consumption. But when we look at it on a global level, we see actually it's not so much a decline in consumption, but actually in 2020, we see consumption growth being, eroding quite significantly. So actually we see flat consumption in 2020, when compared to 2019. And then when we look to 2021, we see actually that consumption bouncing back. Getting that sort of 1% consumption growth. And arguably we look at some research as well, which suggests that during times of hardship, sugar consumption does increase marginally. So it'll be interesting to see how that 2021 plays out. worth noting as well with the end user consumption that it is much more prevalent, these losses in those countries which are hard hit by lockdowns. So we're particularly looking at Europe, America, also, yeah, I guess specifically Italy, Iran as well, and China, seeing some consumption sort of being reduced. And finally, then, something that's very current at the moment is going to be the trade and logistical disruption through COVID-19. National lockdowns threatening to slow trade. We've seen that sort of early on with China, where there was some disruption there, and not necessarily lockdowns with ports, but certainly slowing down of movement of bulk carriers and containers. And also we've seen that much more recently with India and how their lockdowns there are starting to slow ports. Ports are still essential, but there are, slowing and worries of slowing trade flows there, which we'll come back to talk about because that does impact sugar. There is food hoarding in terms of rice coming out of Vietnam, also wheat and grains from Russia, but not talk of sugar quite yet. Still, we haven't reached the peak, so this is something that we are sort of keeping a sort of a tab on as a potential threat, particularly in the short term. So, where's the good news, really? I guess we've been talking about kind of some pretty sort of negative aspects. We've been talking about oil and then on to COVID-19. Is there any good news? Well, I mean, when we go back to the fundamental picture, despite all of these new factors coming into the market, we do still see a reduction in global stocks this year. We've reduced our deficit marginally, but still we see the erosion of stocks to around to the scale around 6.7 million tons in 2019-20. So still an erosion of global stocks, still returning those stocks back to near long-term averages. And then into next year we're looking at a much more balanced supply and demand. So really, yeah, consumption is still exceeding production this coming year. And so fundamentally we do see that erosion and that sort of more supportive force. That is, of course, led by the Asian markets in 2019-20. We see, particularly through flooding and drought, the impact of losses in Thailand, where where Thailand has faced a pretty disastrous crop, to be putting it sort of bluntly. Compared to sort of 15 million tons that we saw last year, this year we're seeing just below 9, which is a drop in about 44% in terms of production. It's been a real disaster, and that actually flows through into their export potential, and of course the knock-on effect for those other exporters who compete in the Asia region, particularly Australia. The other aspect as well has been India has also had a relatively disappointing crop. We've seen that drop 19%, initially dryness, but also flooding there as well, and that drop being 19% too. So both of these major exporters competing into the Asia region, and this is something that I'll pick up in just a few minutes when we get back to the outlook for Australia, because this, in terms of our outlook, has some follow-on effects for Australia. But as you can see, we have a green bar there as well, and we do see somewhat of a recovery in Brazilian production in 2019-20. Brazil coming back as a key player there, and I think that's a really good time, I think, to switch over to Andy and to hear about Brazil's influence this year and how that is going to influence sugar. So Andy, over to you.
Thanks very much, Charlie. And again, good morning to everybody from a fully locked down Sao Paulo. If we look at the first slide about Brazil, I think this just sort of emphasizes the speed and the degree to which things have changed in a very short space of time. And so I was just sort of looking here, comparison of price levels at the end of March with those at the end of February. For Brent oil, a decline of 55%. Charlie's graph showed that very well, just dropped off the edge of a cliff. And in fact, for the Gulf gasoline price, which is basically the origin of imported gasoline for Brazil, the decline was even starker. And I think that's because already there in the market, a big decline in the use of gasoline was being seen as an inevitable consequence of all the lockdown and the reduction in activity in the States. Okay, as Charlie mentioned, in the case of Australia, the dollar has got stronger against the local currency. The dollar's got stronger just against just about everything. And so when you start to look at the ethanol price, or sorry, the gasoline price in local currency terms, because this is ultimately what impacts the price of gasoline in the country, then you can see on that graph, we're still talking about a pretty hefty 58% decline over a month. And that import price, because gasoline at the refinery is in theory priced at import parity, over time that works its way into the refinery price here in Brazil. And as you can see in the graph, we've yet to fully see that decline in the CIF price come through. And of course, I think everybody knows as well that these prices are changing, and in some cases changing by enormous amounts in very short spaces of time. Like Charlie said, Brent oil was up 20% today and still is under $30 a barrel. And then the last point there on the graph is what happens, and this is really what's important to us when we start thinking about ethanol, is what happens at the pump, because that's where the competition in Brazil between ethanol and gasoline takes place. Now, up until the end of March, really very little of these enormous changes had actually filtered through to the pump. So we've seen a very modest change. And if we go to the next slide, please, Charlie. We'll see that no, sorry, one back. No, that's the one, stay there. So at the end of the day, we think that 40% decline in gasoline price at the refinery will probably translate, because there's a lot of tax and fixed costs between the refinery and the point of sale. It'll be something like a 15 or 20% decline in the pump price. Okay, so it doesn't look much compared to some of these other prices, but we'll see in a bit. It's pretty serious. Okay, if we go to the next slide, Charlie. So as Charlie was saying, this is a story of two black swans, basically. And so we've seen now, we've looked at the impact of the decline in oil prices on gasoline prices, but also, of course, here is no different from the rest of the world. There are big concerns about coronavirus spread. As a result, many cities are locked down. And this is just an indication of the extent to which fuel consumption, and that means ethanol as well as gasoline, has suffered. Again, looking at the change in the last month in terms of traffic intensity in 8 or 9 of the biggest cities in Brazil, then you can basically see that the traffic has more than halved in many places. So there's not necessarily a direct link between this and fuel use, but I think it's very indicative. And certainly the anecdotal evidence that we're hearing of sales from distributors, from big supermarket chains that operate in the fuel business as well, we're talking about 60-65% decline in sales. So this is the situation that we face at the moment, and you know it couldn't be much worse for the cane industry, because you've got effectively the gasoline price on its way down sharply, and we know that the gasoline price acts as a sort of ceiling price for ethanol in the domestic market. At the same time, the bottom has fallen out of the market in terms of demand. And the final thing is that the harvest is just beginning. So in pretty short order, the supply of ethanol is going to ramp up sharply. So we've got a situation where increasing supply is going to meet rapidly shrinking demand. And so what that suggests is that basically we already have a lower ceiling price for ethanol formed by a lower gasoline price. But now, given that there's going to be a lot more supply and a lot less demand for ethanol than there was a month ago, we're probably going to see the discount of ethanol to gasoline at the pump widen very sharply. And if we go on to the next slide, please, Charlie. And I've got on the next slide just a sort of comparison of what we're looking at. So if we take a sort of assumption, and of course it's very difficult to say what it is going to happen, but if we imagine that this lockdown, this real sort of asphyxiation of demand carries on for some 4 months in total, maybe that's a bit exaggerated, maybe not. And if oil and the exchange rate stay at the same levels, then we'd expect to see the pump price sort of 15% down on last year's average price. That's gasoline. We would expect to see the discount, and this is at the average over the year of ethanol, widen. So we would expect to see over the year ethanol selling at around about 62% of the gasoline price in comparison with 66%. So it doesn't look much. But when you look at what that means for the actual price of ethanol, and this is an average price over the season, then you're talking about a 20% decline. And I think pretty much everybody on this call is either a business person or a banker. So you don't really need me to tell you that a 20% decline in price is bad enough for your top line, for your revenues, but what it does for margins is absolutely disastrous. So, you know, this is one scenario. Of course, there's a lot of assumptions about oil prices and about the duration of the lockdown, but I think this is for a conservative sort of outlook at the moment, where we're really sort of dealing with a lot of uncertainty. I don't think this is too unreasonable. So if we go to the last slide, Charlie. And of course, that crushing of ethanol prices and margins, even though sugar prices have come down a long way, sugar still in Brazil is looking more attractive than ethanol. As Charlie said, in the case of Australian growers, Brazilian mills did exactly the same. When the price was good in January, February, and the exchange rate was relatively weak, they got a lot of hedging off, pretty much guaranteed an increase in sugar production this year. And of course, this latest sort of decline in oil prices and the disappearance of demand and what it implicates as far as the ethanol market and ethanol prices go is just pushing people further. So you see, this is a graph of the mix, the allocation of the crop between sugar or to sugar over various seasons, and you can see we're projecting a pretty sharp increase in the allocation to sugar, and that works out at about another sort of 7 million tons of production compared to what was produced and exported last year. And I think, to be honest, we haven't finished revising this. There's still scope to go up. And I guess to close this off, that these numbers that you're looking at on the screen, this big increase in the diversion of cane to sugar, that's factored into that world balance that Charlie showed you. And I think, you know, what's happened at the moment is that, you know, whereas a couple of months ago, we were basically saying that the world market needed to pay 15 cents in order to persuade the Brazilians to produce a bit more sugar, which the market needs. Now, with what's happened to the oil price and what it means for ethanol prices, you only need to offer the Brazilian industry somewhere around 11 cents, or not even that, to get them to do the same thing. And so, you know, this is the situation that we're in at the moment. And you know, I will add a comment to say that the actual parity price today of ethanol, the price at which ethanol is trading in the market today, is actually a sugar equivalent of less than 9 cents. Now, I'm not saying necessarily that we go all the way down there, because at some point Brazil will come up against sugar capacity constraints. And like Charlie was pointing out, you know, there's always the concern that there might be problems with logistics, or simply exporting sugar at that sort of price will not be appealing to India, and they might ship rather less than we're expecting. So it's not necessarily saying that we're going all the way down there, but uh, I think it's a measure of if nothing else, how dire the ethanol market looks. And just to finish off with, so right, what do we think about the future? I think two things really. At the moment, if we'd been speaking even a week or two ago, I would have said that everything, this is all about the oil price. And I now think I probably would have been wrong, in that I really think that in the short term, even if Trump and Putin and Mohammed bin Salman make some sort of a deal to restrict oil supplies in the next couple of weeks, here in Brazil, nothing changes about the lockdown, nothing changes about the threat of spread of coronavirus, and so nothing changes about that enormous decline in fuel consumption. And so I think, maybe we see the ceiling price for ethanol go up a bit, but I still think that we're looking at a situation where demand is drastically depleted for as long as it takes to adequately address the challenge of the coronavirus. And how are mills going to react in this situation? Well, some of the best and most capitalized ones, they can probably stock ethanol for a few months, and maybe they can sort of more or less get through most of this period without having to sell at ruinously low prices. Other mills will maybe adopt the strategy of running their mills a little bit below capacity, choosing to operate below capacity, because once you do that, you can actually run your boiling house at full capacity, and in that way you can actually increase the percentage of cane that you use to produce sugar, on any one day or any 1 week or any 1 month. The thing is, of course, if you do that for any length of time, you probably end up not milling your whole crop, and you have to leave a proportion of your crop standing in the field until next year. And it's possible that out of the several lousy options that seem to be available to the industry at the moment, that might be the least lousy option. And of course, for all of those mills which are in a very precarious financial state already, then this could really be the biggest challenge, even though they faced a lot of challenge, but this could be the biggest challenge of all, is getting through the next 3 months. Okay, I'm going to stop there and hand it back to Charlie. Thanks very much for your attention.
Thank you very much, Andy. That's great insight there into Brazil. Just to start off with, I've got just a couple of questions, if that's okay, Andy, on sort of Brazil. And I was just thinking in terms of the mix, Andy. Obviously, we're in volatile times, sort of unprecedented, really, when it comes to the likes of oil, etc. And we start here with a forecast of 45% sugar mix. What's the potential for Brazilian mills to switch? Start to change this mix throughout the season? You mentioned the season's just started. Is there a possibility that could start to change during the crush as market conditions adjust as well?
Yes, it is possible, and I think this is one of the things which is really difficult to sort of think your way through, or to come to any one central forecast, just because the potential swing of all the key variables is great, but let's imagine a situation. If we imagine, for some reason or other, we get through in 3 months' time, it's basically all clear that the threat of coronavirus is well and truly vanquished, and if at the same time then there's been some sort of agreement between Russia, Saudi Arabia, and the US, which props oil prices up, then I think at the point where the fuel demand, domestic fuel demand, comes back online, then things would probably change, fairly rapidly. In that, you would have a fairly tight fuel market. Prices would go up at the same rhythm as demand recovered. And I think that, you know, the sort of latter part of the harvest under those circumstances could look interesting in terms of switching and washing out of sugar contracts and that kind of thing. So you can certainly design scenarios for that sort of swing. But I think we also have to sort of think, you know, if we think about sort of 3 or 4 months into the future. So we're talking about getting to, you know, somewhere like August, and then you've got basically until November to mill. And if our theory is right, that a lot of mills will go slow and not mill everything that's there, and we think there's about 600 million tons of cane available this year. Then already, you know, you've got half the crop behind you, and your capacity to really influence the overall mix is obviously somewhat constrained, just because you've only got half of what you intend to mill left. So yes, I think you can design scenarios for that sort of switchback. But yeah, we obviously two very, very big unknowns in any scenario that you create there.
Excellent. No, thanks very much, Andy. And also to our participants, if you have any questions, please do feel free to drop them into the Q&A box or to the chat. We'll have some time at the end to address those. Yeah, we can talk a little bit more about this then. So onto the final section, looking ahead for Australia, looking more at the scenarios now for Australia and what this means, this new, this uptick in the Brazilian mix, and also the other aspects of OPEC and COVID-19 for Australia. Now, initially, we are going to be looking to start with. I want to look at some of the usual sort of flows that we would expect, particularly around the Asia Pacific region, and how that could potentially change in the sort of the season going forward. Now, we mentioned, of course, earlier on that Thailand's crop has been somewhat a disaster, you know, falling 40% or so. India as well, down too. And so really, you know, in terms of Thailand, we do see, you know, China is often the premier sort of exporter and feeder of sugar into the growing Asia region. We see that 40% fall, and we also see exports cut by similar amounts as well. So difficult season there. When it comes to India, of course, the production side hasn't been so low, but the these recent lockdowns and slowdowns of ports could really start to impact trade. Now, at the moment, we see around about 4 million tons being contracted by India, and these are, you know, of course, these are exports that are still subsidized, but you know, certainly this season, given the deficit, the world needs this sugar and these exports. But this slowdown at ports and potential slowdown in trade of sugar starts to raise real questions about whether India can fulfill some of these commitments, at least in the short term, you know, at least until the lockdowns are lifted, which could be perhaps 6-8 weeks, even further down the line. And so actually, you know, India's capacity to fill those contracts, fill that demand is under question. There's also worries, of course, in India as well about the impact of migrant workers and labour on the late harvest, and potential that actually, you know, there could be some cane left if the lockdowns do extend, you know, to those workers and those cane cutters, etc. in India. Certainly in northern India, that's not been the case, but in other places, it certainly could be an impact. And then we look at Australia and we look at the industry here. And really, we'll get on to the forecast that we have for production, but largely we haven't seen the sugar industry impacted too badly by COVID-19 in terms of certainly port trade and certainly growth as well. Highly mechanized system. Really, the expectations is for now for business as usual. And so, really, you know, when we see, you know, we compare those three scenarios, you know, we see who's sitting out front. There's also perhaps positives on the demand side. Firstly, if we looked at Indonesia, local drought there has seen quite a major increase in the appetite for raw imports, particularly, you know, obviously raw sugar there, and, you know, looking year on year, about 0.7 million tons more sugar being imported by Indonesia, and they recently released quotas for about 500,000 tons of sugar just in March. So Indonesia requiring more sugar, of course, a big customer there of Australia, and also, you know, somewhere India that was getting some buy-in, but really, you know, given given the increased appetite potential there for India not to be operating as usual, does play into the hands of other raw exporters, Australia particularly, and potentially Brazil. The last one I want to mention, perhaps not so relevant for Australia, but China reducing its out of quota imports in 2020. Generally it is for white sugar, but we do see increasing in official imports into China next year. So another potential really for this region, and drawing potentially more sugar from those who have it, and I guess a benefit there to Australia in terms of finding a market. So that's the kind of, the trade flows wise, we do see some positives there, and we do see an advantage for a raw exporter like Australia. And in terms of where we do see other positive shines in terms of demand, we do see this particularly in the white premium. Now, we talked about the deficit and the fact that we could be in a slightly more tight situation this year, even though Brazil is producing much more sugar, and we see this at the moment, particularly in the white premium. Actually, the white premium, of course, is the white sugar market. Take away the raw sugar, it's the margin that many refiners will use. Of course, that this often determines refining profitability. But we see that being some of the highest since sort of for several years. And so in that sense, it's not directly a benefit to raw sugar and to Australian growers, but it does show the signs there are still for sugar. There is still demand there, and we see those exporters such as Thailand and India, which largely do export significant volumes of whites, but also some fairly poor crops in NAFTA as well, causing this tightness in the white sugar market, which of course leads back to some degree. It should potentially could drive those refiners to process more of that raw sugar and could potentially bring more business at the raw sugar end. So something that in terms of a demand story, it's just a shining light there, and shows that the demand is there at the moment. There is a challenge though for our growers, and the significant challenge that we see at the moment has been in farm inputs. Now this again is COVID-19 related, and it follows disruption to basically Chinese factories and manufacturing, where phosphate and agchem is largely produced. So here we have the chart where you see phosphates, urea, and also potash prices rising quite sharply globally through sort of the early 2020. And this isn't all just fundamentals. Some of this is, of course, a weakness in the Aussie dollar. That doesn't help when we're importing or purchasing these sort of products onshore. But really, if we look at how the farm inputs market has been. If we look at sort of particularly phosphates, for instance, China is the leading manufacturer and exporter of phosphates globally. And in February, they were running at around about 40% capacity in terms of producing phosphate. Now that has returned to slightly more. I think a month later, we were looking around about 60% capacity, still running, but still not back to normal. And so there is some shortages there coming through and being seen on the farm input side. And so in our view, we see that these logistical constraints are actually delaying farm input sort of availability by about 3 to 5 weeks, and so that's causing some headaches as well for growers and producers. Mentioned, of course, the Aussie dollar, US dollar is not being helpful in this situation either, given it's an import, and there is also impacting agchem, given that the likes of glyphosate is largely manufactured in China. The lockdowns and the slowdowns there is falling through. But also we have a bit of a double-edged sword in that agchem is not coming through, given it's being imported from China, but also because high demand here in Australia, particularly as those broadacre regions have started to see some rainfall at the early part of the year, starting to gear up for a good cropping season. We do see tightness here in the domestic market too. So really there are some headaches getting hands on farm inputs, and again it's a 3 to 5 week delay we see, particularly for those urea, phosphate and potash inputs. So then, I'll just finish up really with our outlook for the season here in Australia going forward. I mean, we have seen some fairly strong early season prospects. In terms of weather, we've seen some pretty strong rainfall across the northern the coast of Queensland there. Some bouts of rain, periods of sunshine as well, which is really starting to help the crop move along. And really, in terms of our expectations, we see that really with the crop area stabilizing to some degree in 2020, we see potentially a similar crop year on year, given some improved yields, but actually our expectations for a marginally higher cane crop, and we're looking at a forecast of 31 million tons for next year. Now, while last year's sugar production was around 4.2, we're suggesting around 4.2 to 4.3 is sort of the band we're using at the moment. But we can get a bit more specific on that, of course, as the results start coming through in June. Now, this does assume, of course, no late rain, late cyclones or floods, etc. So a little bit of positive news there on that side. So some improved yields through the cane crop here domestically. And then getting on to the price side. What does it mean? We've talked all about this on price-wise. Well, what does that actually mean? And really, we talked 5 weeks ago, we were pretty bullish. We were looking at sort of prices getting up to that 14 cents per pound mark. And still, going forward, we have changed that quite dramatically. Now this, as you can see, we've adjusted our ICE 11 price forecast quite significantly. We've dropped it into that 11-cent mark, and still, for the short term, that still is quite a bullish prediction. And so still, there's still need to move through and see what's happening with oil really before this can be kind of more certain. But we do see support going forward, but into the 12 sort of cent mark rather than getting up towards 14. The saving grace, of course, is the Aussie dollar rate, and we see that staying below or at 0.6 for in the 12-month period, which will be a real saving grace for some of our growers there. Which means that net, when we were talking back sort of 5 weeks ago, we were suggesting 470 as an average price for growers out into the 12-month period, given volatility coming and going. And actually, once we've revised the ICE 11 down and the Aussie dollar, we aren't far from that either at the moment. But still, given today's pricing and given what we're seeing at the moment, this is still a very bullish forecast. And what I must say is that given the new cogs, I guess, in this price machine, the COVID-19 impacts, which is very uncertain, the impact of Brazil and the uncertainty around the mix there, but also the oil price as well, which as we saw just overnight, moved 21%. There is still a lot of volatility in this market, much more so in our view than last year. And so, going forward, whereas 470 is an average price, we could see a lot more sort of dips and moves around about there at the moment. Sort of going forward. So good to be prepared on the marketing side. So I think that kind of wraps up our sort of view today and our webinar today. Just sort of in summary, that we have seen that a sharp adjustment to market conditions just 5 weeks ago, and developments in OPEC, COVID-19 are driving markets and particularly driving volatility. That's going to be the key one. Is that we are seeing going to be seeing pricing to move to quite a much higher degree. Brazil's Centre-South Crush is going to hold significant influence. To what degree Brazil will be delivering additional raw sugar production will be key. But the mix, still to be determined, I guess, completely as we move through. But we're still looking for 45%, which will deliver additional sort of 7 million tons or so. And then finally, when we look at the domestic issue here, or the domestic prospects for Australia, we'll trade. Demand and domestic cane are all positive, but in terms of what we see at the grower level is actually there could be real challenges in sourcing farm inputs, particularly in the short term. And again, still there is a positive price outlook from where we are at current levels, but still I must sort of emphasize that and caution that there's going to be a lot of volatility and a lot of moving parts in this market. So on the back we do look a little bit higher price wise, but still it's worth being very cautious with that on that side. So I think that's everything that we were sort of wanted to talk about today with you all. So, I welcome any questions for myself and Andy. So please do put your questions in the Q&A box and in or in the chat here. And so, Andy, I'll start with a question for you that we've had in the Q&A box. An initial one to start with. Andy, what's the cost of production estimate in US cents by you for Brazil's Center-South sugar mills after the Brazilian real depreciated, to 5.2 against the US dollar?
Yeah, well, that's very much a moving target. So I would say, roughly, the way we tend to think about it is maybe easier to think about it in reais. And look, number one, there's a huge range because we have 350 different mills in the country and a huge range of conditions, levels of efficiency, etc. So you can tell I'm making my excuses already, but we would tend to look at something like 1,000 reais a ton, something like that, and maybe and that in comparison with the long-term average price in reais, that what we would maybe tell somebody in the long term to expect is around about 1,200. So that's the sort of if you want to take that 1,000 reais and convert it with today's exchange rate, which is truly horrifying for anybody who actually gets paid in the stuff. But then that'll give you it in dollars and cents, and I'm probably not capable of talking and doing the maths at the same time. So, but I can, let me just try and call that up now. And, see if it makes, no, I've said it, I'll see if it makes sense. Yeah, that today is a little under 9 cents a pound. It's 8.7 cents a pound. Just taking that. So and yeah, that's obviously there are some that are below that in today's money, and some that are above that as well, and even struggle at average prices.
Yeah. Wow. Okay. That's Geez, that's sort of a tough sort of, sounds like a tough sort of situation there, I guess, in terms of but low cost of production. Andy, another one, just another one that's come in as well, on the more on the trade side. We've talked about kind of ports being disrupted, particularly in China there, and also India, Andy, but Brazil is also on a COVID-19 lockdown. Is there chances or any likelihood at all that the Brazilian ports could be put under pressure by the likes of COVID-19, and we could see a bit of a bottleneck in terms of raw sugar coming out of Brazil?
It's certainly possible. We saw this actually a week, 10 days ago, where dock workers at Santos, which is for sugar by far the most important port for sugar exports. Off the top of my head, it must account for 70, maybe even 75% of sugar exports out of Brazil. But we saw that dock workers concerned that the port authorities were not taking sort of sufficient measures to protect the health of the workers, and threatening to walk out unless measures were taken to better protect better protect them against the potential threat of infection from people on incoming vessels, incoming cargoes, all sorts of people, vehicles entering from the interior of the country as well. And there was a series of discussions held up until the end of March, and as far as we know, the two sides have come to terms, and up until now, Santos and indeed every other port in the country has been working normally. And you know, like many other countries, of course, Brazil is very sort of fearful of the impact that the coronavirus crisis is going to have on the economy in general, and for that reason is very keen to make sure that exports keep flowing. And so, you know, as in just about every other country around the world, and not only as food production being prioritized as an essential activity, but transport and port activities have also been classified in that way. And so, yeah, I can't guarantee that there won't be a problem, but up until now, the one challenge that we've seen seems to have been successfully overcome.
Excellent. Good to hear, Andy. There's just a question here for me here. What is the Australian cost of production per pound? And I'm just dropping this into just doing a similar sort of calculation. I think it's obviously cost of production depending on the region. But if I'm using a sort of a high cost of production, perhaps for a an irrigated sort of sort of an irrigated type system here in Australia, and then I take the current exchange rate. Sorry, hang on one moment, and then 0.61. I believe we're not too far away at sort of at sort of 9 or 10 cents, but I'm just going to work that out for you. And then divide by 2204 is I've got here just about 10 cents or 10.2 cents per pound in the item number 11. Is the sort of Australian cost of production. That would be a high a high cost of production for a high system using irrigation, etc. Still there's capacity to for many growers that would be lower, but still that's probably a good one to use, and also using the current exchange rate there. So I've just 10.2 is the one we can do for that question. Another one for you, Andy, from Tony Olson. Hi, Andy. What impact has coronavirus had in Brazil? Cases, deaths isn't mentioned in our news reports here.
We're at the stage where the numbers are increasing dramatically, and so I haven't seen today's numbers, but off the top of my head, I think yesterday it was some 6,000 identified cases, and I think that the number of deaths I think is in the sort of mid hundreds, maybe sort of 300 or 400. I confess, I don't know. I mean, I think we're in this we're in this situation where, of course, the testing has not been extensive. So I think the number of cases diagnosed is obviously a pretty poor indicator of the extent to which the disease may already have spread in the country. And what effect has it had? Well, many, just across the country now, most of the states have imposed some sort of, at least sort of closure of big public events. Restaurants and bars are only permitted to operate on a delivery-only basis. So all of the things that you were talking about the erosion of demand via food service, that's certainly happening here. And of course, it's too early to have any. Oh, right, somebody's updated that. See, look how quickly it changes. Yeah, now we're in that sort of exponential phase, and of course, we assume that some of that loss will, in terms of consumption, will be offset by increased domestic consumption. As I say, the part of my presentation, that by far the biggest impact on this industry has been what it's done to the fuel sector, and how long that will last. And I think probably an issue for not just for Brazil, but for many other countries as well, is of course, when you start thinking about recovery of demand, then you won't necessarily spring back to full demand the day that the governor of your state or your president declares the emergency to be over. I suspect this whole experience will leave people with a lasting sense of caution, and that we maybe not have a sort of V-shaped recovery in terms of consumption of fuel and maybe
Andy, sorry, I think you just dropped out with that last sentence there.
Are you having difficulty hearing me, Charlie?
Just that last sentence, Andy. Just that last sentence. I think your line just dropped out there. Yeah.
Okay. Well, I was just saying. I mean, there's no guarantee of a strong immediate recovery in demand for fuel or many other commodities.
No. Okay. And yet, as you mentioned, we kindly had on the chat somebody update us on the confirmed cases for coronavirus. Yeah. Confirmed cases 7,910, 15% increase from yesterday, and deaths at 299, almost 300 there. And Andy, while we are on the subject of coronavirus, will this downturn in coronavirus have an impact on new cane plantings in Brazil?
No, I think at the moment I don't think anybody's thinking that far ahead. But although some planting takes place throughout the year, that the main period for planting is January, sort of December, January, February, and into March. So we've pretty much got that behind us for what's normally most of what's planted in that period will be 18-month cane. But the planting period for this year is pretty much behind us. And so I think then that's one of these great uncertainties is what sort of status we'll be in by the time December comes around.
Excellent. Okay, and yeah, unfortunately, I've got another one here for you. I know I'm bombarding you a little bit with questions, but lots of questions on Brazil coming through today. So we've got Matt Page from QSL. Hearing ethanol supply lines are full, as evidenced by force majeure earlier this week. Assume this means, regardless of where oil price lies, until demand resumes in Brazil, mills forced to produce sugar first up? Question mark. So until demand resumes in Brazil mills because of I guess ethanol supply lines, your Brazil mills will be forced to produce sugar given that those full ethanol supply lines anyway. Is that correct?
No, absolutely. That's what I was sort of saying during the presentation. Is that demand has just shriveled, and so prices are going to be at an enormous discount to the oil price, and yes, in that sense, the ceiling price is not really relevant. It's more a question of the balance of supply and demand, which will result almost inevitably in an enormous discount of ethanol prices to the gasoline price in the immediate future, in the next month or two. And I think, of course, that's sort of just emphasizes that sugar will be a top priority, and to a certain extent because in a sense what's changed is sugar. I think ever since we saw the sort of price spike in February, a lot of locking in of good prices at that time. I think a swing towards sugar was as of that point sort of pretty much on the cards for everybody, and I think we're maintaining that. It's just a swing to sugar at a lot lower sugar price, and depending now with this extra variable of how long the lockdown goes on for, and to what extent that continues to really pressurize the ethanol market, how much more we can go towards sugar. And I think I can see that the rest of Matt's question, and I think that yes, the truth is that 45. I think this is not the last time that we're going to take a look at this number, and especially if we imagine this the lockdown going on for a longer period of time. The swing, I suspect that number will rise. And if also, if in an effort to sort of restrict the supply of ethanol, we get into this scenario that I mentioned of the mills sort of deliberately running slower so that they can produce more sugar, but they maybe end up milling, leaving some cane standing in the field at the end of the year, then I think that's the sort of what that does to sugar, I guess, is a sort of balance between how much you leave in the field, so to what extent you cut back on that 600 million ton base case forecast, which is what we have for the cane available, and to what extent the mills then can ratchet up the mix. I would say at the moment, and you mentioned in your summing up that with a full crop, assuming the full crop is milled, with a mix of 45, we're talking about an extra 7.5 million tons of sugar being produced in comparison with last year. So we're talking 33.5 million tons. If we went to max sugar with no reduction in cane milled, then we could be talking about an increase of 10 million tons of sugar compared to last year. So somewhere around about 36 million tons of sugar output.
Wow, that's quite a could be still quite a rise, and a lot to sort of see into the future. Yeah, that's incredible if it rose to sort of 10. Andy, there is we have one last question here, given we're over time. So this one will be the last one. And is there going to be any problem with crushing due to the COVID-19 risks? Of course, labour working in mills, etc. in Brazil. Is that going to be is that a concern of yours?
It's a concern of ours, and it's obviously a big concern of our clients as well. And we've been speaking to them to try and understand what sort of, if you like, operational measures they're putting in place to protect their staff and to best ensure that they keep the show on the road. And very like Australia, that field operations obviously are highly mechanized already, and so the threat that they potentially see there is more in the collective transport of workers to and from the field. And so what many of our clients are doing is they're effectively doubling the amount of transport that is available to ferry workers from the satellite towns around the mill to the areas where they're working, so that the workers can be widely spaced within the vehicles during transit. The other times when people tend to come together, like at meal times, then they are staggering the meal times again to allow that more space between people at these moments. So in the field, those are the sorts of issues that they've been looking at. And in the factories, in the mills, what they've been looking at is some of them have given, to start with, a couple of weeks of mandatory leave to anybody who's 60 or over, with the recommendation to spend those 2 weeks at home, which apparently is not always followed rigorously. There is also obviously anybody in administrative managerial capacity, to the extent they can work at home, they do work at home. Some of the mills are instigating regular body temperature checks of their workers, and also of any visitor that comes to the mill. So any driver of a truck that comes to take away sugar or take away ethanol, will have their temperature checked before they get anywhere near an area where other people are working. So these are the sorts of measures that are being sort of put in place on the ground exactly to combat that threat of an interruption to activities because of an outbreak of infection. And I would imagine that the industry in Australia is will implement when the harvest starts exactly similar measures. And yeah, let's all hope that they work and they keep people safe and things keep going.
Yeah, no, good point, Andy. And I think the concerns here as well for our clients, and in terms of the milling operations here as well, are quite similar. In terms of ensuring that staff are, I guess, safe and are not transmitting the virus during the harvest, and of course that the mill operations are able to continue. So it's certainly a concern for growers and mills. And there's we've been hearing sort of. Yes, the measures are going to be, going to be sort of implemented, going to be put in place, split shifts and more sort of management, etc., of different teams, etc., to make sure that if the virus does reach the mill, it doesn't spread sort of rapidly throughout, doesn't take out the whole workforce in one go. So I think there's the measures that can be put in place to manage that risk and ensure the mill keeps going. But of course, it's it's an uncertain time. It's a sort of a new prospect as well, and just one that we'll have to see. But certainly a lot of measures going in there to mitigate the influence and the threat, I guess, of COVID-19. There's a couple more questions that I will just get through very quickly. We'll close off the questioning now, given that we are getting sort of 10 minutes over the hour. But happy to answer these last few. And we've got one here, probably for me. How is the WTO sugar investigation going against Indian sugar subsidies? Well, Glenn, with that one, we are still, it is still being raised at the WTO. We haven't heard anything new there for some time, and to some degree, the dispute would have been delayed. I know the appellate body at the WTO was certainly going through a period of change at the start of this year, and has obviously slowed down its decision making, or its sort of its panel outcomes. We have noticed that it has started to operate more recently, and it's starting to come out with decisions on certain commodities and certain trade, but still there's nothing sort of latest really on the WTO sugar investigation. So it has been brought by Brazil, and it is going through the hearing, going through the process, but the dispute hasn't been sort of realized quite yet. In terms of how, I guess, India is operating, as in terms of its WTO dispute there, given that last year, we saw 5 million tons of exports subsidized from India to reduce the burden of its domestic sugar stocks. Even though it was brought to the WTO, 6 million tons was subsidized this year. So it shows that India isn't necessarily taking this step or taking the steps to heart. It's continuing to subsidize, continuing to do that. But really, so it's only in time that we'll know what will happen there against the investigation. It does take time. It can take several years, 2-3 years in some cases. But I guess what we know at the moment is that the fact that we are sort of entering a deficit, and really there is a need for to some degree, well, I guess ahead of Brazil increasing the mix. There was a lot of talk about Indian sugar needing to sort of reach being needed on the world market to sort of meet supply. So I don't think necessarily it's going to have such a large influence as it did last year. It's not necessarily going to be dumped, and given current levels, and certainly where we see the ethanol parity for Brazil, actually the Indian export parity, even with subsidies, is still quite far away from the ICE 11 is quite far away from that Indian export parity. So still, it's not worthwhile for Indian mills to be exporting at the moment anyway, at sort of current prices. So still, investigation is underway, but in terms of the influence, certainly not going to have, those subsidies are certainly not going to have a big influence, or so much of an influence this season. Certainly not going to keep that pressure on prices. And last one, we have a question here on the price sort of outlook. So what is going to support sugar price climb back above 12 to 12.7 as per your price outlook, if 10 to 11 cent is already paying better than ethanol today? So this is our price forecast from our team in London, our markets team in London, and they are suggesting that really it's kind of based on a much more supportive or a recovery in the oil price there. It's talking sort of more about the a recovery back to 12 cents given sort of the oil price and a bit of a normalization of current current sort of markets, etc. But still, I think it is a very good point. I think for the moment it's difficult to see sort of 12 cent away at the moment, given like you say, it's paying better than ethanol today, and this quarter we're suggesting still going to be around just over 11 cents per pound for our sugar price. So but later in the year, as we sort of get back to normal, or if we get back to normal, that's our price view, but it is based heavily on an oil recovery there. And what is the outlook for the Brazilian real in the next 3 quarters? I don't have that on the top of my head, and I know that we have that on file, so I can get back to you on that. I don't know, Andy, do you have the outlook for the Brazilian real in the next 3 quarters?
I don't have the outlook for the, well, I do. I have the official Rabobank one, but
Yep.
honestly, I thought it was going to be the next 3 quarters of an hour or something, because it has been incredibly volatile. But no, at the moment, obviously, the markets are incredibly turbulent. Our economics team, a local economics team here, have a forecast for the end of this year at the moment of around about 450, and today we're at 526, 527, round about that. So obviously that we're in a very turbulent sort of risk-off environment, along with all of the issues that we've been talking about in commodity markets. Of course, we know that the whole asset markets in general have just fallen off a cliff. Risk aversion is at its greatest, and of course emerging markets tend to suffer under those circumstances as well. So we have seen money flow out of the country. We also see of course more concern about the country's general sort of a long-term fiscal balance, because like again many other countries, that the public purse is being mobilized in order to try and offset the damage that will be done to the economy, to jobs, to incomes, to society, with the prospect of 3 or more months of these sorts of circumstances. And of course all that feeds into a higher prediction of public debt in the future. And so I think all of these factors have been conspiring in the short term to put more pressure on the real here, and so I guess this forecast of 450 by the end of the year is some sort of alleviation of the pressure, some sort of maybe not a return to normal, but being on the way back to normal. But this is also a forecast which has changed dramatically over the last month, and it could perfectly possibly change considerably over the next month as well.
Excellent. Okay, well, thank you very much, Andy. I think that concludes our questions, and of course, apologies, we are about 50 minutes over the hour, but I wanted to get to the bottom of everybody's questions, so thanks all for your patience, and thanks all for logging in today. It's been great to be able to share our sort of insights and our thoughts, our research on the sugar industry from home amid this turbulent and uncertain time. But yeah, thanks all for joining us, and stay healthy and safe as well. And Andy, thank you also for joining us all the way from Sao Paulo. It's been great to have you on and to hear what's happening there in Brazil.
Thanks very much, Charlie, and to everybody, thanks very much for your attention, and stay safe.